All right, let's break down Karat Packaging's third quarter earnings call. And the story here is really a classic Wall Street tug of war. On one hand, you've got this fantastic sales growth, but on the other, profitability is getting squeezed and squeezed hard. So let's dive into the numbers and figure out what's really going on. First up, the big headline number that got everyone's attention, record net sales, up over 10% from this time last year. And the company made it clear, this wasn't just about hiking prices. Nope, this was driven by solid, real volume growth, a really strong performance on the top line. But, and this is a big but, here's the other side of that coin. Gross margin shrank by 410 basis points. We're talking 4.1 percentage points. That drop tells you everything you need to know. While they're selling a lot more stuff, they're actually making less profit on every single sale. And that is the core conflict we need to understand. So here's how we're going to get to the bottom of this. We'll look at the Q3 scorecard, unpack their massive new growth driver in paper bags, pinpoint exactly what's causing that margin pressure, check out management's game plan, and then we'll wrap up with our take on what to watch for next quarter. Okay, first up, let's just lay out the key financial results side by side. This is where that story of growth versus profitability really comes into focus. This table just lays out the core disconnect perfectly. You see that healthy 10.4% jump in net sales? Great. But that 4.1 percentage point drop in gross margin? Well, that just cascades all the way down the income statement. It leads to an 18% drop in net income and a 21% hit to adjusted earnings per share. This is exactly the conflict the market is trying to figure out how to price. Now, for the bull case. Because despite all those margin issues, management spent a lot of time on the call talking up this huge new opportunity. They believe it could be a total game changer for the company's growth. So Karat has jumped into the paper bag market, and they've done it in a big way. They've already locked in a 2-year deal with a major national chain. That's worth about $20 million a year right there. And on top of that, they're already in testing with 2 or 3 other large chains. Management is not thinking small here at all. They are explicitly targeting over $100 million in new annual revenue from this one category. And, this wasn't just some throwaway line in the presentation. During the Q&A, the CEO, Alan Yu, he doubled down on it. He said he's confident they can scale this new business to a $100 million run rate, pointing to all the major restaurant chains that are ditching plastic as the key driver. Okay, now let's get back to that margin pressure. We've got to dig in and find out exactly what's causing the squeeze we saw in the numbers earlier. Now, what's so interesting here is how clearly this chart identifies the villain in our story. It's import costs. Driven by higher duties and tariffs, they have just exploded. They jumped from 8.6% of sales in Q3 last year to a staggering 14.4% this quarter. This one single factor is pretty much the main reason for that sharp drop in gross margin. So, your management, you're facing this intense pressure. What do you do? Well, the call outlined a pretty clear, multi-pronged strategy to fight back against these headwinds and still deliver value to shareholders. Their first move is all about supply chain agility. They are actively trying to rely less on Taiwan, which has been a major source of that tariff pressure. As you can see, they've already cut imports from there down to 42% from 58% just last quarter. At the same time, they're ramping up domestic sourcing to 20%. This diversification is absolutely key to avoiding future cost shocks. And on the capital front, they're really focused on shareholder returns. They reaffirmed the dividend, authorized the company's first ever share buyback program for $15 million, and they're planning to pay down a $20 million term loan just using cash on hand. That shows a lot of confidence in their financial strength, even with all this margin pressure. So, putting it all together, what does this actually mean for investors? Let's look ahead to the next earnings call with our analyst reading and key takeaways. We're kicking things off with a market perform rating. Why? Well, that powerful growth story is incredibly compelling, but right now it's being pretty much completely offset by some very real and very significant profitability challenges. To put it simply, the bull case is all about that potentially transformative $100 million paper bag opportunity and just continued strength on the top line. The bear case is that the margin pressure from tariffs and foreign exchange just won't go away and that it ends up outweighing all that growth. For now, we see these two forces basically keeping the stock in balance. Looking ahead to Q4, we expect sales to stay really strong, probably hitting the high end of their 10 to 14% growth guidance.
But we also think gross margins are going to stay stuck in that compressed 33 to 35% range. Because of that, we expect the stock will probably trade sideways as the market waits for a clear winner in this growth versus squeeze battle. The one number you absolutely need to watch is import costs. Any improvement there could be a huge catalyst for the stock.
And as always, a reminder that this analysis is for informational purposes only and is not financial advice.